Well, it looks like the markets have since done a 180 and we're starting to make our way to the downside. The S&P 500 just about 30 minutes ago was up over 1%. Well, now the S&P 500 is only up 0.20% and we are one big red candle away from going negative on the day. There is one piece of news that came out that really caused this snowball effect that started this bearish sentiment in the markets, but we are heading into Tesla earnings here in after hours, and that is going to be very important for the rest of this week, and that is going to dictate how the markets trade. And there are some things you need to know about Tesla heading into their earnings that is a lot different than Netflix. Netflix was a pretty easy trade to call this bullish rally, right? And we did profit immensely from that. We bought Disney calls, $17 into $50 a piece, even more than that at the high. That's where I personally sold out. We bought Fubo, $3 options into $15 a piece. We got the Snapchat calls. We have the Square calls. We made a pretty penny based off of Netflix, and that was because Netflix had really low expectations and everyone thought that Netflix was going to do bad. So it didn't take that much to actually make Netflix go up in a big way. That is because last quarter, Netflix said they expected to lose 2 million subscribers for Q2, and they only lost 970,000 subscribers. So that was seen as a positive thing. Also, Netflix did say that third quarter, they expect to add 1 million new net subscribers. So that is what has given Netflix this positive rally, about 5% today, and yesterday was about 15%. So Netflix up about 20% because they sandbagged last earnings. Sandbagging just means, giving a really bad number, just throwing the sink at the markets, just a lot of bad news. So it's a lot easier to come in and beat on that next quarter. Now, the thing with Tesla, I don't personally invest in Tesla, but I like to listen to the earnings call. Elon was on the last earnings call, and he said they expect 50 to 60% growth for 2022. And that is why Tesla is valued so highly. That is why Tesla has a 98.42 PE ratio. It's because, yes, they brought $5.52 billion to the bottom line in 2021, but Elon is expecting 50 to 60% growth. So Tesla doesn't have a low bar. Tesla has a very high bar. And there's two main issues with Tesla. Well, three actually. The first one we know about, which was the first declining month of deliveries in the past 2 years. Not a good sign. And the markets are forward looking. So if the markets expect this to keep happening, well, Tesla's valuation would have to come down pretty sharply, probably 25, 35, 45% from these levels. The second thing is the foreign exchange rate. Imagine this like if you went to, call it Europe, right? You went to Germany or France or the UK and you had to convert your dollars into pounds. Well, now you have a 1-to-1 ratio. So it's great when you're going from America essentially to Europe, right? Usually the euro is valued much higher than the US dollar. Well, when you are doing business overseas and you're used to euros being valued so much higher, then you convert those euros into US dollars. Well, you get a lot more US dollars and it looks a lot better once you report earnings. That is not the case now. So if you're in Europe, if you're anywhere globally doing business as a company like IBM, 95% of the revenue comes from overseas. Netflix, 60% of the revenue comes from overseas. When you take that foreign currency, convert that back into US dollars, and you get way less US dollars, that hurts company earnings. And Tesla, as you guys know, does a lot of business in Europe as well as a lot of business in China. So that is going to hurt their bottom line earnings, and that is not going to be a good thing. That is number two. Number three is a term called demand destruction. We have seen this already in the real estate market with new home builds down dramatically, buyer sentiment down dramatically. People are canceling putting their homes on the markets, and you are seeing the lowest level of new mortgage applications in the last 30 years happening right now. That is because interest rates a year ago were 3%, now they're 6%. So home affordability has dropped dramatically. Well, let me tell you, the same thing has happened for cars. That's why real estate And cars are so highly connected because people get loans on these things. That's why real estate market went to shit during 2008. Car market went to shit during 2008. So they are very closely connected. And if you start to see demand destruction in the auto market as well, that is going to be a very negative thing for Tesla. And that is going to be something the markets potentially look at and say, hey, how bad could this get? What is the worst case scenario for Tesla if we went through a hypothetical 2008 situation all over again? So those are really the three things that are going to be the main things that I want to watch for, at least on Tesla's earnings coming here today in after hours. Now, besides that, you have the Atlanta Fed GDP Now tracker estimating a negative 6% GDP print coming next Thursday. Wednesday is the day that we are expected to get the Fed raising rates by at least 75 basis points, if not as high as 1%. It looks like only 75 basis points. We're pricing that in with about a 70% probability. So if we got a 1% rate hike, that would definitely move the Fed futures around, and that would freak the markets out just a little bit. You are also seeing the yield curve inversion, still inverted about 21 basis points. This is a strong signal. It's still the most inverted it has been since the year 2000, and that was 20 years ago, right? So not good. Things that we are seeing, not a good sign. And usually the yield curve doesn't even invert this much. You can even see during 2006, the yield curve only inverted 0.16 basis points. We are at 0.21 basis points, as low as 0.25 basis points. You have to go back here to 1989 to get a yield curve that was more inverted than it is right now. And that at the low was inverted 0.35 basis points. So what we are seeing right now is not a good sign, and I don't think we are free and clear in the markets. I don't think this is something that a rally has to last until the Fed comes out and says, yeah, guys, we're going to stop raising rates. We're going to essentially put the brakes on all of that. That's when things could start to look a little bit better in the markets and we could get more stability with our rallies. But as of right now, you really want to play the opposite in the markets, right? Netflix, for an example, yesterday, everyone expected bad earnings. So I went bullish on Netflix earnings. There was a very low bar to beat, whereas Tesla earnings, everyone is expecting a good number, at least not a terrible number. Now, if you get a terrible number, that's where, expectations are really not pricing in that bad number. Now, what has really caused this drop that we are seeing right now in the markets is that Google has said it will pause hiring for 2 weeks after saying last week it would slow its pace of hiring for the rest of the year per the information. And this was actually confirmed by Google itself. And that is what has caused a 0.70% drop from the top. And we'll see what happens, by the end of the day, what happens with Tesla earnings. That is going to ultimately dictate how we trade for the rest of the week. So that is really the information that you guys need to know. If you guys are still here and watching this video, well, my earnings trade for Tesla that I put on was a July 29th $600 Tesla put for about $296. If you look at the option flow on Tesla, it is extremely bearish. Some hedge funds are betting that Tesla could drop over 25%. Take a look at this option. This was actually the same option that I just said, a July 29th $600 put. This single order was worth $2.4 million a hedge fund put on. July 29th, 650 put for almost $3 million. So it's not very positive, and you're only seeing a positive order value of 16%. 100 orders totaling $52.14 million. So the situation here is really going to fall on the back of Tesla, and that is going to be the thing that could really help the markets in a big way or hurt the markets in a very big way. Here in after hours as well, you do have Discover, Crown Castle, Steel Dynamics, Kinder Morgan, CSX, Alcoa, United, and obviously Tesla. That is going to be the one that really dominates headlines. Tomorrow you will have pre-market AT&T, American Airlines, Nokia, Domino's Pizza, Philip Morris International, And after hours, Snapchat, Intuitive Surgical, Boston Beer, Capital One, Mattel, Silicon Valley Bank, Seagate, Western Alliance Bank Corporation, PPG, and Friday you have Cleveland Cliffs, Verizon, American Express, Twitter, Next Era Energy. Those are really the ones that I personally want to watch. Now let's go ahead and switch gears and talk about AMC stock. AMC is up about 4.71% at the time of recording this video at $17.12 per share. Really over the last 2 days or so, you've been bobbing in between $16 and $18 per share. My price target by this Friday was originally $18 per share, and I think that is still very possible as long as Tesla has decent earnings and you don't get a market-wide 2 to 3% sell-off coming tomorrow. So that is really what is going to determine if AMC can get above 18, can get to 18, or potentially to $20 or higher. The MACD is very bullish and it looks really good. We still have a lot of room to continue to get more bullish before you'd have your MACD warriors coming out and saying the stock has to come down because the MACD is really, really overbought. Same thing with the RSI. RSI is at 67.94, still in the healthy range, close to that overbought level, but not quite there yet as of right now. If we go ahead and pull up the Ortex data, the thing that everyone wants to know is what is the cost bar rate, what is the short interest. If we click on the short interest tab, you could see cost bar rate, the max is at 13.06%, which is very high. The cost bar average at 11.95%, cost bar minimum at 9.87%. So that does look very good in my personal opinion. Still waiting on that cost to borrow max spike, but what you are seeing spike is the estimated short interest of free float. That is sitting at 18.52%. The short interest dollar amount is $1.56 billion. Free float out on loan 26.88%. Shares out on loan 138.58 million. Days to cover at 3.34. Cost to borrow at 10.27 and 100% share utilization. So that all of this is looking very good in my personal opinion. The fact that AMC is still holding a 5% gain even when the markets have started to come down is definitely a positive thing rather than not. If we look at the option activity, a lot of very large option orders coming through, specifically 19 orders totaling $1.24 million, positive order value of 83%. So I think on a technical basis, you're looking very good. Ortex data looking very good. And I think just to put this out here, a worst case scenario, you're going back to the previous level of resistance, which was this 50-day moving average, which is sitting at $15.59 per share. If we get that bullish reaction, like I said, then you could make your way to $18, $20, $22 per share, which would be the 200-day moving average by the end of this week. So that is going to be it. Thank you guys for tuning in. Hit that like button and subscribe to the channel if you guys want to come trade with me live in real time. Link down below in the description of this video. You guys enjoy the rest of your day, and I will see you in the next one.